All right, here we are with the first example of our depreciation methods. This is the easy method. This is a straight line method. Remember, straight line method only has one step, one major step. And so we're going to go through the process. We're also going to journalize everything so you can kind of see how this goes. But let's start. So it says on January 1st, Papa Company purchased a copy machine with a list price of $15,000. They received a 5% discount for cash payment in full. The machine was delivered FOB shipping point for $250. Papa Company paid $1,500 for the installation and setup of the machine. Papa Company expects the machine to have a 5-year useful life and a salvage value of $4,000. So the first thing we need to do before we do anything, before we can depreciate anything, is we've got to figure out what the DAC is. So in order to do that, we need to add up what's necessary. Remember, it's those things that is necessary to get it to our facility and ready for its intended purpose. This being a copy machine, so we always start with the list price for the invoice cost. The invoice cost being $15,000. So that's a good starting point. The next would be the discount. We did get a 5% discount because we paid in cash in full. So 5% of $15,000 is $750. So we can take that out. Next is the delivery cost. FOB shipping point, so that is the buyer's responsibility. We are the buyer, so we do have to pay that, and that is getting it to our facility. So we will add $250. And next is the $1,500 for the installation and the setup of the machine. That's getting it ready for its intended purpose. So we will include that as well. And that's everything. So we actually included everything in this one, minus the useful life and salvage value that comes later. So if we add that up, that's going to give us a total asset cost of $16,000. All right, so that's what we have to put it on our books for. So we need to go ahead and create the journal entry for this. So this will be 1-1. We will debit the equipment account, make it copy machine of 16,000, and then we will also credit cash because that's what we paid for. So that's just the journal entry to bring it in. That's what we put on our books for. Then we have the rest of the year's operational entries. We don't know what those are. Those can be anything. But then we get to December 31st, and we need to do our first depreciation adjusting entry. So we need to figure out what our depreciation amount is going to be. So we're going to use the equation total asset cost minus my salvage value divided by the useful life. And that's going to give me my depreciation per year. So our total asset cost here we know is going to be 16,000. We just calculated it. Our salvage value, it gives it to us at 4,000. And our useful life is going to be 5 years. And if we do the calculations there, that's going to give us a depreciation per year of $24,000, or excuse me, $2,400. Okay, now before we move on to the next one, there's something really important about this equation that I want you to pay attention to, and that is the numerator, the 16,000 minus the 4,000. That amount right there is going to equal 12,000, and that's what we call the depreciable base. Okay, that's a very, very, very significant number. What that means, or what the depreciation or depreciable base is the maximum an asset can be depreciated and the minimum a company wants to depreciate. So that is the max number and min number you want to hit in total depreciation over the life of this asset. Okay, we don't want to go past it. We don't want to go under it. So typically when I do a depreciation problem, what I do is I create a table, a secondary table, because the table is just going to give me extra information that I can refer back to and answer questions if necessary. And it's just 3 columns. I'll start with year 1, and then the years in the first column, depreciation expense the second column, and accumulated depreciation in the third column. So for the first year, I'm going to have depreciation expense with straight line method that we're using of $2,400. And therefore, my accumulated depreciation is going to be $2,400. Okay, and then I'm going to put that into a journal entry for this year, for the first year. So I'm going to 1231 depreciation expense because this is what I've used of that asset, 24,000. And then I'm going to put it into accumulated depreciation, 2,400. Excuse me, not 24,000, 2,400. All right, that's year 1. Now let's go to year 2. Now this is why I said the straight line method is the easy one, because it's one calculation. It's 2,400. We calculate it 2,400 per year. We're going to use that over and over again for 5 years because that's what the useful life is. So again, adding to our table at the bottom, year 2, 2,400 depreciation expense. This time we're going to add 2,400 to what's already there, which is 2,400. So that's going to give us 4,800. But our journal entry is still going to be the same. It's going to be 1231 depreciation expense 2,400, and then accumulated depreciation 2,400. Remember, depreciation expense closes out every year, accumulated depreciation carries over each year. So we're just adding that amount to what's already there. All right, year 3, same thing. Year 3, we're going to add or put 2,400 into depreciation expense and also put it in accumulated depreciation, which adds to what's already there, 7,200. Our depreciation journal entry is going to be 1231. Same thing, depreciation expense 2,400, accumulated depreciation 2,400. Again, the same thing for year 4. The same thing, 2,400 depreciation expense. This time it's going to be 9,600 accumulated depreciation, and our journal entry is still going to be the same. Very repetitive. But that is straight line. All right, year 5, last one. We're going to do the same thing. Year 5, 2,400 depreciation expense, and then we'll close it out to accumulated depreciation of 12,000. Our journal entry is going to be the same. This is the final 5th year, 2,400 and 2,400 in depreciation expense, accumulated depreciation. Now, really quickly, I want to note this before we go to the next slide, is that notice what is in our accumulated depreciation in year 5. We have 12,000 in year 5. We have 12,000 as our depreciable base that we stated earlier. That is the point that we want to hit. And if you're doing this right straight line, you're going to hit that because you're taking your depreciable base and dividing it over however many years you're going to have in useful life. So this is how you do a straight line depreciation problem. Now, there are also a lot of questions that could come from this. There's a lot of things that come from this. And there's also, I want to show you kind of what it looks like from the balance sheet's perspective as well. So if I was going to look at the balance sheet for year 1, I would have assets, cash, whatever it may be, accounts receivables, whatever it may be, whatever the rest of them are going to be. I could list them. And then towards the end, I will see equipment, copy machine for $16,000. That's my TAC, and that's what it's going to be. Remember, I keep it at what I paid for it at. But I'm going to take away the accumulated depreciation. So for year 1, my accumulated depreciation, if we look down to that table, year 1 under accumulated depreciation, we have 2,400. So I will subtract 2,400 away from that, and that's going to give me a book value for the copy machine of 13,600. That's for year 1. Now let's look at year 2. The only thing I'm going to change is the accumulated depreciation because in year 2 I have 4,800. That will give me the 11,200 as the book value. In year 3, it's going to change to 7,200, which means my book value is going to be 8,800. And in year 4, it'll be 9,600, which gives me a book value of 6,400. And then in year 5, it'll be the full 12,000, which is my depreciable base. And that's going to give me a book value of my 4,000, which is also my salvage value. Now, what are some of these questions that can come from a problem like this? Because there's a lot of things that's going on. So let's just say, hypothetically speaking, the question asks us, what is the depreciation expense for year 2? Well, that's why I like having that table at the bottom, because all I got to do is look at year 2, look at the column that says depreciation expense, and I will find 2,400. And as a matter of fact, it's going to be 2,400 for all 5 years. Okay. All right, let's look at another type of question you can see. You could see, what is the accumulated depreciation balance at the beginning of year 4? Well, be careful with this one because remember, all of our adjustments, all the events that are happening are at the end of the year. So if it's saying what is the beginning, well, that means the end hasn't occurred yet. So if it says the beginning of year 4, we're actually looking at year 3's information because year 4 hasn't occurred yet. So we need to go back to year 3, and our accumulated depreciation in year 3 would be 7,200. Again, coming from the table. Another one, what is the book value at the beginning of year 5? Well, beginning of year 5 hasn't occurred yet. So we got to go back to the beginning of, or the end of year 4. And so we'll use year 4's information. So we'll backtrack it and say year 4, our accumulated depreciation is 9,600. Therefore, our book value is going to be 6,400. And that is what the answer to that question would be. So it just gives you a couple variations of what questions that could come from this. There's quite a few, as you can see. But this is how you do the straight line method. I hope this made sense. If you have any questions, please leave them in the comments below. But other than that, you'll have a good one.